January 16th, 2026, early afternoon. And if you're staring at your screen right now, you're being fed a carefully curated illusion. The tickers are bleeding red. Silver just collapsed more than 3% in a single session. Gold is sliding. The headlines are already written for you. Metals mania is over. Commodity supercycle hits the wall. The talking heads are lining up to tell you that the party is finished, that the exit doors are closing, and that anyone still holding metals is about to get trapped inside a burning building. And if all you do is watch the screen, that story feels convincing. But markets don't move on what's loud, they move on what's true. While retail traders panic sell silver and commentators recycle the same tired narratives, something far more important is happening beneath the surface, quietly, methodically, and completely off-screen. One metal is refusing to play along with the fear. One metal is standing perfectly still while everything around it shakes. Copper, not surging, not collapsing, just holding its ground at levels that should not exist if this were truly a broad commodity unwind. And that kind of behavior doesn't happen by accident. I've spent over a decade watching commodity markets, and I built this channel for one reason: to see what matters before it becomes a headline. I'm not here to hype candles or chase momentum. I'm here because something crossed my desk this afternoon that couldn't wait for tomorrow's news cycle. While everyone else is watching the emergency exit, I'm watching the private entrance. And what I saw there changes the entire story. Because while silver is flushing weak hands and gold is being treated like a fear asset, copper is being quietly pulled out of the public market by the largest corporations on Earth. This isn't a correction. This isn't a crash. This is a reallocation. And most people won't realize it until it's already over. Let's talk about the number that stopped me cold. Copper, $5.86 per pound. In a session where precious metals were getting pummeled, copper didn't flinch, no panic, no cascade, no sympathy sell-off, just stability. And in markets, stability during chaos is never neutral. It's a signal. Understand this clearly. If copper were just another industrial commodity riding the same wave as silver and gold, it should have dropped. Risk-off sentiment, collapsing metals, bearish headlines. This was the perfect environment for copper to crack. It didn't. Instead, it welded itself to the floor. That tells you something critical. There is size underneath this market, real size. The kind of buyers who don't care about headlines, intraday volatility, or retail sentiment. Buyers who are not trading copper but claiming it. This is what I call tectonic stability. It's not exciting. It doesn't trend on social media, but it's the exact behavior you see when a market is being quietly absorbed by players with a long time horizon and zero interest in public price discovery. Now compare that to silver. Silver is emotional. It trades like fear. When confidence breaks, silver doesn't walk. It falls down the stairs. And that's exactly what you're seeing. Paper traders reacting to narratives, dumping contracts, trying to front-run a story they think they understand. But while paper silver is being sold, physical copper is being locked away. And here's where the story breaks wide open. Because this afternoon it became clear that copper isn't just being bought. It's being removed from the system entirely. Not through exchanges, not through futures, not through the LME, directly, quietly, permanently. And once copper leaves the public market, price becomes irrelevant. Availability becomes everything. Here's the part no ticker will show you. Amazon Web Services didn't buy copper on the open market. They bypassed it. AWS signed a multi-year direct offtake agreement with Rio Tinto, straight from the source. No exchange, no intermediaries, no price discovery, just guaranteed supply. Samsung followed the same path. Let that sink in. These are not speculative trades. These companies aren't betting on copper prices. They're not trying to flip contracts or time a cycle. They are doing something far more serious. They are de-risking their future. When a company like AWS locks in copper supply years in advance, it's not because they think prices might go up next quarter. It's because they've concluded that waiting is more dangerous than overpaying. That's the tell. If copper were about to collapse with the rest of the commodity complex, these deals wouldn't exist. Corporations don't lock in multi-year supply at premium rates unless they believe availability, not price, is the real risk. And here's the most important part. Copper acquired this way never touches public inventories. It doesn't show up in LME numbers. It doesn't appear in warehouse reports. It simply disappears into private balance sheets. So while the screen tells you oversupply and collapse, the physical market is telling a completely different story, one of withdrawal, not abundance. This is the moment copper stops behaving like a commodity and starts behaving like a strategic asset. The same transition oil went through, the same transition lithium went through. And now, copper is next, and the institutions already know it. What we're witnessing right now isn't random volatility, it's a decoupling. Gold and silver are being traded as fear instruments, insurance policies for when people think the system is breaking. Copper is being treated as something else entirely. Infrastructure oxygen, every AI data center, every electric vehicle, every renewable grid, every high-speed rail line. They all need copper, massive amounts of it. That's why the copper to gold ratio matters more right now than any headline. This ratio is the market's emotional compass. When it falls, the market is scared. When it rises, the market is building. And after months of consolidation, that ratio is turned. Not violently, not dramatically, but decisively. This is how macro rotations begin. Not with fireworks, but with quiet persistence. Institutions don't wait for confirmation. They create it. And while retail investors debate whether silver is dead or gold is going to the moon, the real shift is happening somewhere else entirely, from defense to offense, from preservation to construction. If you're positioned only for fear, you're fighting the last war. Here's the part the mainstream never wants to discuss. Copper supply is broken, and not temporarily. It takes 12 to 15 years to bring a new copper mine from discovery to production. That's not a delay you fix with stimulus or interest rate cuts. That's physics, permitting, geology, and capital intensity colliding. And the quality of copper deposits has collapsed. Ore grades are down more than 30% since 2000, meaning miners must move vastly more earth just to extract the same amount of metal. The easy copper is gone. At the same time, demand is accelerating faster than at any point in modern history. EVs use 4 times more copper than combustion vehicles. AI data centers consume thousands of tons each. Renewable grids are copper hungry by design. This isn't cyclical demand. This is locked in demand. And when supply can't respond, prices don't spike immediately. They grind, slowly, relentlessly, until the market finally realizes there is no release valve. And by then, the copper is already gone. To understand why copper is behaving differently, you need to stop thinking like a trader and start thinking like a physicist. Mining is not software. It doesn't scale. It doesn't respond to demand signals in quarters or even years. It responds in decades. From the moment a copper deposit is discovered, the clock starts ticking. Exploration, feasibility studies, environmental assessments, community negotiations, financing, construction, and ramp-up. Each phase is sequential, not parallel. Miss one step, and the entire timeline stretches. That's why the average copper mine takes 12 to 15 years to reach production. And here's the brutal truth. Even if prices doubled tomorrow, it wouldn't materially change copper supply before the mid-2030s. This is what most market participants fail to grasp. They assume price is the solution. In copper, price is just the symptom. Now layer in declining ore grades. Since 2000, average copper grades have fallen more than 30%. That means miners must dig deeper, crush more rock, burn more energy, and spend more capital to extract the same tonnage. Copper today isn't scarce because companies don't want to mine it. It's scarce because nature already gave us the easy stuff. So when analysts talk about supply responding, what they really mean is capital chasing increasingly marginal geology. And that doesn't happen without sustained elevated prices. Prices far above where copper trades today. This is why copper shortages don't explode overnight. They tighten slowly, invisibly, until the system finally breaks. And by the time price reacts, the physical metal is already gone. Here's where the traditional copper playbook fails. In past cycles, copper demand was optional. Construction could pause. Manufacturing could slow. Projects could be delayed. Copper demand was elastic. That's no longer true. Today's copper demand is structural, not cyclical. Electric vehicles aren't a luxury upgrade. They're a regulatory mandate. Automakers aren't choosing EVs because they're fashionable. They're choosing them because emission standards leave no alternative. An internal combustion vehicle uses roughly 20 kilograms of copper. An electric vehicle uses 80 kilograms. That's a 4-fold increase per unit. And global vehicle production doesn't stop just because GDP dips. Now add AI. A single hyperscale data center requires thousands of tons of copper for power delivery, cooling systems, and redundancy. These facilities are not speculative. They are mission-critical infrastructure in an AI arms race where delay equals irrelevance. And here's the key insight. These projects cannot be paused indefinitely. If Amazon slows, Microsoft accelerates. If Google hesitates, Meta expands. Competition locks demand in place. This is what separates the current copper cycle from everyone before it. Even in a recession, copper demand doesn't vanish. It backs up, creating deferred pressure that explodes later. Demand isn't disappearing, it's queuing, and queues eventually overwhelm systems that can't expand. Now let's talk about the trap. In a recession, copper prices may fall. That's the headline risk everyone fixates on. But what happens behind the scenes is far more important. When prices weaken, mining companies don't accelerate production. They cut exploration. They delay projects. They shelve marginal deposits. Why? Because mining is capital intensive, and capital flees uncertainty. This creates a vicious cycle. Lower prices, less investment, weaker future supply. So even if demand softens temporarily, supply deteriorates faster. This is the copper paradox. Downturns make future shortages worse. Unlike factories, mines cannot be restarted on demand. Once development stops, years are lost. Skilled labor disperses, permits expire, financing dries up. By the time the economy recovers, the supply gap has widened, not narrowed. This is why every major copper bull market begins in an environment of skepticism and disbelief. The seeds are planted when no one is paying attention. And right now, attention is elsewhere. Whenever copper shortages come up, someone inevitably says the same thing. Relax, copper is recyclable. That statement is technically true and strategically misleading. About 30% of global copper supply comes from recycling, but recycled copper is not interchangeable with virgin copper. High-performance applications, AI servers, EV motors, high-voltage grids require ultra-high purity copper. Impurities reduce efficiency, increase heat, and shorten lifespan. Recycled copper often fails these thresholds without extensive re-refining. And re-refining is expensive, energy-intensive, and limited in scale. You can't melt old plumbing and wire the future of AI with it. Recycling helps at the margins. It does not solve structural deficits. This isn't a green fantasy problem, it's metallurgy, and physics always wins. Here's where perception breaks down completely. People look at copper at $5 per pound and say, it's already expensive. That's backwards. When you factor in labor inflation, energy costs, regulatory burden, and declining ore grades, the all-in sustaining cost for many copper producers is approaching $4 per pound. That leaves razor-thin margins. At $5, miners aren't being rewarded. They're barely surviving. For new mines to be justified, copper prices need to be sustainably higher. Not briefly, not speculatively, structurally. Prices don't rise because miners want them to. They rise because the system requires them. And the system we're building, electric, digital, AI-driven, cannot function without copper. $5 isn't the top, it's the floor of a new regime. Every copper bear eventually reaches for the same argument. China. China is slowing. Property is weak. Manufacturing is uneven. And because China consumes roughly half of the world's copper, the conclusion feels obvious. If China slows, copper collapses. That logic used to work. It no longer does. What most analysts miss is what kind of copper demand China is reducing, and what kind it is accelerating. Yes, traditional real estate construction is weaker, but that's old copper. Pipes, wiring, rebar-adjacent demand. The new copper story lives elsewhere. China is the world's largest builder of renewable energy infrastructure. It dominates global EV production. It is aggressively expanding grid-scale battery storage and ultra-high voltage transmission. These are copper-intensive by design, so while one category of demand softens, another expands, and the expanding category uses more copper per unit than the one it replaces. This is substitution, not destruction. Even more important, copper demand is becoming geographically diversified. India, Southeast Asia, Latin America, and parts of Africa are entering their infrastructure build-out phase. Electrification isn't a Chinese story anymore, it's a global one. China slowing doesn't end the copper thesis, it redistributes it. And redistribution is harder for supply to meet than concentration. One of the most dangerous assumptions in commodity analysis is that exchange inventories tell the whole story. They don't. LME inventories only track what's registered, visible, and eligible for delivery. They say nothing about copper pulled into private corporate stockpiles. When AWS signs a direct offtake deal, that copper vanishes from public circulation. It never touches an exchange. It never becomes part of reported inventory. This is what I call the dark inventory phase. Official numbers may look stable, prices may appear range-bound, but availability is quietly shrinking. This is exactly how shortages begin, not with a crash in inventories, but with a slow migration of metal away from price discovery. The market doesn't realize there's a problem until it tries to source material and can't. By then, price is no longer the negotiating lever. Relationships are. As physical supply tightens, pressure builds in the paper market. Futures markets assume liquidity. They assume deliverability. They assume that contracts can always be settled. Those assumptions hold until they don't. When exchanges raise margin requirements during periods of tightening supply, leverage gets flushed. Speculators exit. Volatility increases. That's not stability returning, that's stress being exposed. Paper markets work beautifully in surplus environments. They break down in scarcity. And copper is moving from one regime to the other. The financial media isn't malicious, it's reactive. Volatility gets clicks. Stability gets ignored. A 3% move in silver is a headline. A 6-month grind in copper isn't. So the narrative stays focused on fear, crashes, and emotional assets, while the real structural move happens quietly in the background. This isn't deception, it's incentive alignment. And it's why retail always arrives late. Forget predictions, watch signals. I'm watching 3 things. First, inventory drift. Not dramatic collapses, persistent declines despite flat prices. Second, price behavior. If copper holds above key levels during broader risk-off events, decoupling is confirmed. Third, physical premiums. When spot copper trades above futures, scarcity has arrived. None of these will trend on social media. All of them matter. Copper doesn't explode, it exhausts. This is a time-based trade, not a momentum trade. The longer copper stays firm while demand builds and supply stalls, the more pressure accumulates. Eventually, the system has to clear. And when it does, it won't ask permission. Institutions don't need perfect timing, they need guaranteed access. That's why they move early, that's why they pay premiums, that's why they bypass exchanges. They understand something retail often doesn't. Being wrong on price is survivable. Being wrong on availability is fatal. Copper is crossing that line. This isn't about calling tops or bottoms. It's about positioning for a structural reality. You don't need copper to go vertical next month for this thesis to work. You need it to remain scarce while the world electrifies. That's already happening. Most people won't notice the copper shift until it's obvious. By then, contracts will be signed. Inventories allocated, mines committed. The move won't begin when price spikes. It will end there. The beginning is now, quiet, boring, and ignored. Silver is the headline. Gold is the insurance. Copper is the infrastructure. The era of copper as just another commodity is ending. It's becoming a strategic asset, treated less like a trade and more like oxygen. You can watch the screen, or you can watch the withdrawals. The institutions have already chosen. The only remaining decision is whether you understand why, before the market forces everyone else to.